Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening, and please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Welcome back to the Westside Investors Network podcast. I'm your host, Trent Werner. On today's episode, we are joined by Brad Johnson, founder and CIO of Evergreen Capital. Brad's going to share how his journey in his early career in investment banking and private equity has transitioned him and Evergreen Capital into a key player in the real estate investment world. Brad's going to share Evergreen Capital's three main investment vehicles and asset classes, as well as what you should be looking for as a limited partner investor in your operators. Now let's welcome Brad Johnson. Brad Johnson joining the WIN podcast today. Brad, thank you so much for joining us.
Well, thanks for having me, Trent. It's good to be here.
And Brad, for people that don't know who Brad Johnson is, obviously you're a founder and CIO of Evergreen, but I want to let you take a minute and tell me and our listeners who Brad Johnson is.
Yeah, so I am a former real estate operator who has morphed really into more of an allocator in real estate and also private equity. But I got my background, got my start working in institutional real estate, mostly in large buildings, apartments in San Francisco, New York, kind of 24-hour cities, working in investment banking, real estate investment banking. Then swapped over to private equity, the buy side. I worked in acquisitions for a couple of groups that were out there buying real estate deals on behalf of pensions, endowments. And so I've seen the institutional world. And then when I was about 33 or so, I decided, hey, I want to make this jump into being an owner myself and be the principal and raise capital. And a lot of guys in real estate, as you know, have that itch, even if they work as a W-2 employee in the space. A lot of guys or girls decide that they want to go off on their own. And I had that itch after I had my first son. I remember showing pictures to friends and family of my son, and he was always asleep in them because dad was off to work early, dad was home late working on deals in an investment banking environment, which was, intense. So I wanted to go make my own hours and go, hunt what I kill. So I left off around 2013 and partnered up with a guy that had a lot of experience in manufactured housing, so mobile home parks. And I identified that niche because I would see constantly in a lot of the loan portfolios that we were participating in or helping to sell as an investment banker, that there would be manufactured housing pools in these mortgages. And these loans had high yields and low default rates. And so obviously those two things shouldn't go together, right? It should be the opposite. So that was kind of the catalyst to going, hey, I like this niche. It's a little under the radar. I can probably, raise money as having zero experience in the space versus trying to go do a $500 million office building wasn't going to happen without any principal experience. So that's what I did. We went out and we built a portfolio of 2,300 pads and then sold that in 2020 around COVID when the pricing didn't make much sense for buying.
Yeah, and manufactured home parks were, the cat's meow in 2020 to, even still today, you're seeing a lot of them and self-storage and those kind of things. And I know you mentioned that you saw this loan product and that's what kind of turned you on to it. But when you actually started diving into it, aside from high yields, low default rates, what were some of the other benefits or attractions that made you start in the manufactured home space?
Yeah, it's really my whole thing is trying to mitigate the downside. And I know, people say that, of course, with most investments, but truly, because real estate, you're not going to get a 10x on deals. I mean, occasionally, right, there are those opportunities that come up, but for the most part, it's about minimizing your losses and trying to hit doubles over and over again consistently. And so with manufactured housing, the nice thing is that you, generally speaking, don't have to worry about demand, right? This is the last stop on the affordable housing train. And so you have overwhelming demand for affordable housing in this country, right? It's a bit of a crisis. And yet they're not building any more parks, right? It's very difficult to get permitting and entitlements to build a new mobile home park. It's not impossible in some places like Texas, but it's very challenging. And so you have this weird dynamic where, demand's going up and supply is going down, right? Okay, I remember Economics 101. That's a pretty good place to be from a pricing power standpoint. And so that's just an overarching, nice benefit, structural benefit to the space. The other one is the fact that, you own the land and the tenant owns the home. And so land doesn't have too many surprises from a capital standpoint, right? Whereas a large office building has a facade, it has a boiler room, it has giant lobbies, it has tenant improvements, it has leasing commissions, it has all these expenses that can destroy a year's worth of cash flow just with one negative surprise. Whereas a mobile home park is like a parking lot, right? You repave the roads, you fix some of the pipes, but there's not giant capital expenses. So that gives you more confidence in the cash flow stream. So that's another reason why I liked it.
Yeah, and a lot of people that I've talked to that have focused on that space say the same thing. You're dealing with tenants, but you're not dealing with the toilets. And so typically it's less of a headache. But I was curious to get your thoughts on it because
it's still operationally challenging, right? It's like people kind of fall in love with the thesis and try to do it from 2,000 miles away. And that is very difficult to do, right? Unless if you're buying in Phoenix, right, and it's fully occupied, maybe you could hire a third-party manager just to babysit, collect the rent, and keep the wheels on. But if it's in a softer market, it's a long way away. It's not full. It's a value add. Maybe 10% of the homes you actually own as the park owner. And maybe incomes aren't as high in that market. Oh, wow. In some small market in Ohio, and they kind of get excited about it, thinking that, these full, I'm just about this parking lot. But those are way harder to run, and you need to handle things out.
Right. And then, so obviously that's where you got started when you became or started focusing on the operations side. Now you mentioned something about being an allocator, and it's still on the operations side. So when you are allocating funds, are you still focused in that manufactured housing space, or are you opening up to different asset classes now?
So we focus on a few different verticals with Evergreen Capital. The idea with Evergreen is that it's my family's money was kind of the starting component of it. I wanted to put my capital into things that I thought we could hold for a very long term, hence the word evergreen, because that's how you compound wealth, right? Do it in an after-tax, tax-friendly manner where we can get some depreciation benefits and we can compound and not have to sell after 3 years, pay recapture tax, pay the IRS, then go out and find a new investment after 6 months, right? And have that cash drag. You actually don't need as high of a return to compound, pretty substantially with an open-ended type of investment versus more shorter term. And so, we have 3 verticals that we tend to focus on. One is GP stakes. That's buying into the general partnerships of private equity firms, both in real estate and traditional private equity, where you're buying companies. That's a great business because you get asset management stream, you get to participate in the promote, but other people are doing the hard work. We also do commercial real estate debt. That's more new to us, but we like that, the return stream, the predictable income, just like the management fees for GP stakes. Regardless of what's going on in the economy, that income stream is pretty reliable. And today it's quite high. You can get equity-like returns for debt risk. So we like that. And then we still invest heavily in manufactured housing through our platform called Vintage Funds. So Vintage Capital does only really, primarily manufactured housing. And that I've been investing with operators for quite some time. I think we're up to 16 or 17 different operators in the space. I cut my teeth as an operator, so I can kind of see, hey, do these guys have the team? Do they know what they're doing? Are they investing in the right markets? And so it's been fun to be both an LP, just a straight investor writing checks to those guys, or even helping out and being a minority GP if they need more help, more expertise, more involvement from me. It's been a lot of fun.
And you mentioned the debt side is newer for you guys, and I know you're not the only people that have kind of transitioned from maybe a more traditional syndication type investment into this debt space because of how the market has shifted. Two questions for you. One is, what made you guys start seriously analyzing and underwriting that sort of investment and ultimately taking the leap into that side of investing? And how long ago did you do that? And kind of what led you to really dive into this side of the real estate world?
Yeah. So I've only started doing it personally for our own capital. And we're going to start later this year bringing in our clients and investors. And that's generally how we work, right? I kind of learn it, invest in it, feel it out, and then we will start offering it to our clients. And so I just would be looking at the equity-like returns, right, for something that's 60% levered. And my whole life I've invested at equity, which is the top of the capital stack, right? And you have all this debt, and even sometimes you have a pref equity component in between. And so that's a lot of people ahead of you if things are going bad, right, with the property before you get your equity back. Thankfully, it's never been an issue. Like with all the properties that we invested in as mobile home parks, we never had a loss for an investor. We always paid the distributions. But now that things are a little bit pricier, and you can get debt returns at double digit, right, for that 60% loan. I mean, that feels amazing from a risk adjusted return standpoint, which is an abstract idea. But to me, that is more valuable than a 12, 13 IRR, or even 15 IRRs in a not a great asset or maybe an okay market. If it's got to be for equity, it's got to be 15, maybe 13 if it's amazing market, it's amazing asset, right? Versus that lower risk, low double digit debt investment. Now we'll see. Like, we could go back to ZIRP. I don't think we're going to go back to zero interest rate environment anytime soon. But AI has, all bets are off with AI. I mean, who the hell knows? 20 years from now, we might have very challenging employment, scenario where robots are taking care of everything. And so you have to go back to a zero interest rate world. And then maybe all of a sudden debt isn't interesting anymore. But I like the fact that it is, it's tied to a floating rate component. So it has inflation protection built into it, right? So if they keep raising the rates, we get a raise. And I just like like I said, the risk return.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more. And when you're, evergreen, like you said, longer term positions is what you guys focus on. When you're getting in on the debt side, what's that whole time or that investment timeline look like? 3 years, 5 years?
Yeah, so that's the nice thing. Well, hopefully 2030, right, is the idea. Now because debt is a little more liquid, than equity than but investing into a property. Debt, paper you can actually sell, in a fairly efficient way, right? It's fairly easy to trade paper versus, my LLC shares in this one property. And they're pools of loans. It's not like we go make one loan. We tend to invest with other operators that have giant portfolio of loans. And so we want 100 plus loans in our investment. And if we need to liquidate, then you can raise, or if our investors need to liquidate, they can raise their hand. And as long as we have 90 days, we can either use the liquidity that we have on hand, or we can call some of those notes or sell some of those notes to return the capital. So it's not like you have to lock up for 30 years. But if you're getting a great yield that's coming monthly, and you don't see the values cratering where it would impact your 60% loan, why would you want the capital back is kind of how I think about it.
Right. And I guess in my opinion, I guess 101 level of LP investing into real estate syndications, you're looking at, your classic multifamily or commercial investments. Maybe it's value add, maybe it's development, whatever it may be. But those are kind of your typical. Now, when you move to the debt side, it seems like it's a little bit more advanced, higher level. For a limited partner investor that's wanting to invest in this side, but they've only heard about the value add or the development deals, how would you break it down for someone that wants to invest on that side as a limited partner? I know you've talked about the lower risk potentially and solid yields, but aside from that, why would someone want to go to the debt side instead of going on a development deal that's targeting a 30% IRR?
Well, yeah. I mean, 30, it's like apples and oranges, right? So that we'll always have a bunch of equity exposure, right? Mobile home parks, stocks, GP stakes. Like that's the riskier side of the portfolio where you can get, the mid-teens to high teens, maybe even 20% returns. But we also in our portfolios like to have an income component, like to have something that looks like bonds. I don't invest in treasuries. I don't understand why you would want to give the government your money for 5% for 30 years. That doesn't seem like that great of a trade to me, considering inflation, is probably running at 3%. So I think more about debt as a bond replacement. And so it's not even fair to compare it to an equity investment or a multifamily development, just because it fulfills a different goal in your portfolio. Like it should be regular income that's extremely reliable, that only blows up if we have some extreme outlier events, right? In which case, we probably have bigger problems to worry about. But yeah, I mean, the nice thing about equity too is that it's more tax efficient than frankly debt. Debt is going to be taxed at ordinary income, those payments. A lot of real estate entrepreneurs, especially real estate entrepreneurs, have ways to mitigate that with depreciation from their other investments, but not everybody does. And so, a multifamily investment or a mobile home park equity investment, especially if 100% bonus depreciation comes back, is extremely tax efficient, right? And especially if you're not selling it within 3 years, right? If you're actually holding it for a while, you don't have to do the depreciation recapture, and the after tax returns are extremely compelling on that standpoint.
So, Brad, would you say that there is an avatar or an ideal person with a certain situation that would want to maybe have a higher percentage of their portfolio in the debt side?
Yeah.
Since it is a little bit more risk averse?
Yeah. So like I said, there's some people that view it as a bond replacement. It just kind of goes in the fixed income side of their portfolio. Like, hey, this is the safer side. And they have both, right? So we have a lot of real estate investors and entrepreneurs that use it for that. And then there's some people that are retirees that really just don't want to take any equity risk. They hate volatility. They don't want any drama, and they prefer debt investments over equity. We have some of those that invest with us, or at least looking at the new debt product that we're releasing, but like more income focused investments like debt that pay recurring, immediately, right? Versus a value add deal. Like sometimes, today you buy a new property, it takes a while to get up to a 5%. It could take a couple of years to get to 5 or 7% yield if it's a value add deal. So that tends to be the mix of people. It's like either somebody that just wants to treat it as a bond replacement or a very conservative investor where that is actually the riskier side of their total portfolio. They have no stocks, they have some bonds, and then they want to get a little bit more of a spike, a little more yield than a treasury at 4.5% for a 10-year. And so they look to something like debt, like commercial real estate debt.
Yeah, that's what I was hoping you would say. Because it seems like there's, your investment career or path goes into, different phases. You have your accumulation, your growth, and then your protection phase over your course of your investment journey. And it seems like the people that are in their protection or preservation phase would benefit from moving funds or moving capital or allocating some capital to a more, I guess, safe side of their investment in real estate, right?
Yeah, it's just lower risk. Yeah, a lot of people thought that they were doing that, investing in real estate in 2019, 2020, 2021, and they got into some deals that were highly leveraged, maybe with floating debt, and realized that, oh, wait a minute, real estate is cyclical, right? It is not a bond. And when you're investing in equity into real estate. So you got to know what you're doing. You got to invest with great sponsors, with great track records. And so for the people that realize, oh, wait a minute, this thing, can go down, debt could be a better solution for them. But, I always say it's like you should have both, right? They fulfill completely different things in a portfolio.
Well, and it sounds like you and Evergreen and Vintage Capital have different options for your investors, right? You have something that may be a little bit more aggressive, and then you have the safety blankets or something that's a little bit more stable that you offer to your clients.
Yeah. The common thread is we try really hard to figure out and find opportunities that we think are disproportionate upside to downside risk, right? It's hard for me to imagine say a portfolio of mobile home parks conservatively leveraged, which most of them are like 50% LTV today. It's hard for me to imagine how a 10 plus properties disappears and blows up everybody's money, just because I've been in the space for so long and all the benefits that we talked about. Commercial real estate debt, same concept, right? It's hard for me to imagine how a pool of 100 conservatively leveraged loans, how does that blow up unless we have a 2008 crisis that really takes down the financial system or real estate as a whole. And then the GP stake side, once again, it's nice recurring revenue from just the asset management fees that are contractual from endowments, pension funds, insurance companies, right? So these are contractual payments that they've made with the general partner that happen regardless of the market's tanking. So those are like bond payments that come in. Once again, difficult to kill. That's kind of the overarching thread is like, I want to invest in things for us that are hard to kill. Yes, you can always come up with negatives. There are no guarantees in any investing. But when you look at that list of like what can go horribly wrong here, you want that list to be small relative to your upside options. And that's how we think about the skew there.
Yeah, and you mentioned something about, I guess, underwriting the operator, right? Making sure that you're investing with good operators that have experience. If I was a limited partner investor looking to invest with an operator and I came across Brad Johnson at Evergreen Capital, what would our phone call look like? And how would you instill confidence in your investors to let them know, hey, I am a seasoned vet. I know what I'm doing. This is why you want to invest with us.
Yeah, well, I'm not a great salesman. So we have other people that are pretty good at investor relations. But, like I said, I try to just focus on reality, which is, okay, well, we've been doing this for, 12 years and we got a flawless track record of making distributions and not missing one. And, we have great, returns that we've posted full cycle. So we show them our track record. We say, hey, look, we have a fair amount of invested clients that are happy. And those are the facts, and we're not going anywhere. And so if that is a good fit for you, great. That's kind of how I think about it. I don't want to put it, I don't want to try to like, oh, this is some sexy product that you need to get into and force it down somebody's throat. It's like, here's the reality. Here's what we're doing. Here's how we think about risk and returns. And we hopefully can hold these things for 20 to 30 years and really compound our capital together because we have skin in the game alongside you. If that sounds great, let's do it. If not, there's a million other options out there. It's kind of how I approach these things.
Absolutely. And then just kind of a random question. It sounds like you guys have been pretty adaptable with the market changes and the shifts that have occurred over the last 12 years. What are you seeing in today's world in 2025? I know you said that that investment side is new for you guys, but are there any other niches or vehicles that you're looking at in the current market or in the current investment world?
Those are the three components that we're really focused on, the three strategies. There are some that I'm looking at that I like that rhyme with those strategies, right? I've made an personal investment in a couple of NFL teams, not as like I'm some big baller, I'm like own an NFL team, but you can now via private equity groups make a reasonable size check size and actually own a piece of an NFL team, which is a lot, is pretty cool. I have a hard time seeing NFL lose money long-term as long as you don't have to sell, right? Pretty much anything that you don't over leverage in a good asset, as long as you don't have to fire sell it, you're probably going to, do pretty well. And so I think that will be, I think more accredited investors will have that opportunity in the next 5 years to own professional sports teams. That's interesting to me. I don't know if we'll end up offering that to our clients, but I'm learning that space right now because I do like the idea of, this is live TV that they can still sell advertising for. Whereas what other TV are you watching ads on, right? It's like everybody's cutting their cords. Everybody's moving to Netflix. So this is one of the few opportunities where you actually get millions of people watching one specific thing at one time. So I like that trend. I also like infrastructure. So it kind of rhymes with real estate. Infrastructure, they're kind of throwing data centers into that category, which I don't know. I tend to like more of the ports, airports, toll roads, that kind of infrastructure historically has had extremely good returns relative to the risk. Once again, very few negative losses for any infrastructure firms, but good cash flow. And so once again, it rhymes with that, pretty stable cash flow and great upside opportunity, very few defaults. So the downside feels pretty mitigated.
Absolutely. The other, I don't know if it would be classified as infrastructure, but I know kind of a trend right now is solar farms where people are leasing land for long periods of time to solar fields.
Yeah. So Brookfield's kind of, one of the bigger players in the space. We actually, in our GP fund, made an investment into Stone Peaks, a general partnership. They're one of the largest infrastructure private equity firms. They invest in that as well. So renewables and energy infrastructure at large are a big component of infrastructure investments.
It's always a fun one, especially with how the world is changing right now. I've always kind of kept a pulse on that and seeing some of the upsides to investing in that side.
And it's almost like a backdoor play on AI, right? You don't have to pick the winner. You don't have to pick, okay, which one of these 6 models is going to actually ultimately stand out and get all the market share, because they all need energy, right? They all need energy. They all need power. They need water. They need ways to, clean that energy. So data centers and infrastructure, energy infrastructure, grid, I think that's going to be a powerful trend. Where a lot of money is flowing to that part of the world. And so people that are interested in that space can look at infrastructure funds as well.
Absolutely. Well, Brad, did I miss getting you to talk about anything that you wanted to talk about today?
No, I was just happy to come on and chat with you. I think it's great what you guys are doing, and it's always fun to talk to other operators in the space. We really like to be a resource for operators that we've invested with in either a GP capacity or just as a straight limited partner. And so it's exciting what you guys are doing in the Pacific Northwest. And I'm glad we had a chance to chat.
And where can people hear more from you or connect with you if they're interested in getting in touch?
Yeah, they can go to evergreencap.com. to see about our longer term investments, our open-ended evergreen investments. And if they're interested in mobile home parks, they can check out vintage-funds.com.
Perfect. Well, thank you so much, Brad.
Well, thanks, Trent. Nice chatting with you.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.